My next guest is still constructive on the sector and sees opportunities. Let's bring in Jason Helfstein, senior internet analyst at Oppenheimer. Jason, welcome. Brent Thill, I don't know if you caught our chat with him yesterday, but he was saying like people don't even want to invest in technology anymore. Are you getting kind of the same vibe?
The conversations with clients have just been probably more social and stock oriented lately. It's definitely been a tough time to be a tech investor.
More social than stock oriented. I suppose the thing that we're trying to figure out is whether this is just, quote unquote, this kind of pandemic era correction, or whether it really could be the start of a much longer winter for tech stocks like what we saw post.com.
Yeah, I mean, I'd go back more to the financial crisis. So, look, if we are going to go into a kind of a true recession, consumers stop spending, kind of financial panic again, like you saw during the financial housing crisis, then you could say yes, they're still 50% lower in some of the multiples of the big tech companies. Look, ironically, what got Google to its low was when Facebook came public. People were worried for Alphabet that they were going to lose share to what was Facebook, now Meta, and I think the stock got down to like something like it was like 12 times earnings in the financial crisis, and then 15 times when Meta came public. So look, there's definitely downside in a Facebook and Amazon. At Facebook, our Meta, we actually have not seen the stock. This is new lows as far as the multiple, or within new lows. So look, I think you pick your spot. However, generally being a value investor in tech is dangerous. It's typically more momentum, and so we can talk about themes around that. But that's the challenge. Do you want to be? I heard one of your last guests talk about GARP investing. Typically in tech, you care more about the trends than you do about the valuation.
Sure. And I mean, you have a very tough coverage space here. And as I understand it, you have a buy rating on all but two of these names. And these include everything from Angie to Etsy, Farfetch, Fiverr, Lemonade, Match, Peloton, Redfin, Roku. I mean, this is a tough list. So at what point do you have to reassess the entire valuation framework here? I mean, how many more months do these companies have to stay at current prices before we go, they're not coming back?
So look, we've done a few things. Historically, this is a group that was valued on a multiple of sales or multiple of gross profit. With most of the companies now, we've said, okay, if you can't put a multiple on kind of this year, next year, cash flow or earnings, go out to, let's say, 2025 and discount it back. For the companies that you don't have really visibility on 25, they're not names that are top of mind with investors. Also themes, right? Anything that's advertising or consumer is hard right now unless it's perhaps like a Facebook or an Alphabet, okay? So perhaps investors should look at something like online dating, should have, kind of recovery tailwinds, right? But for example, take Etsy, very good company, but offline retailers are still giving share back to, online retailers are still giving share back to offline. And then the question is, once that share correction goes back to kind of a normal level, do we have a recession in the consumer? So it's super hard. So again, I think you've got some of the big names you can kind of get more comfortable valuation. That's why Alphabet really hasn't moved much. Or you're looking for other names, something like online dating. I think, investors have tried to look at Uber. It's been super frustrating because that should be a reopening stock, but it hasn't worked. So again, I think investors are trying to figure out what's working right now outside of kind of the largest mega caps. None of it's really working.
Yeah, no. And look, Uber's a broken business model. You don't get credit for that anymore. People are tired of waiting. It was a $100 billion IPO, and it's IPO'd at 45 in 2019, and here we are. So